stocks may be a better choice for you than futures or Forex. Now wait, before you click away from this video, if you've been struggling with futures or Forex to find profitability, or if you are new, maybe you're getting chopped up when the indices or commodities or currencies are ranging for weeks, you'll want to stick around for some points that you may have never heard before. If you clicked on this video, that means that you are curious, and you'll most likely hear all types of reasons why you should choose Forex or futures over stocks on YouTube. And most of that advice doesn't come from professional traders. My name is Abdullah. I've been trading for 5 years, and the purpose of this channel is to bring the professional knowledge to the independent trader like you and I. I learned about trading through multi-level marketers and social media influencers. And when I decided to get professional training, I was surprised by how much professional traders' advice differed from the social media influencers. So I'm going to give you 5 reasons why stocks may be a better choice than Forex and futures. I've traded Forex, futures, and stocks, and I like to bring a perspective to YouTube that is hard to come by. If you already have edge with Forex or futures, and it's been proven for 3 years or more with live money, then this video may not. Let's jump into the first point. I have indices, SPX 500 in this window, Laser Photonics, and Summit Therapeutics, and this is in the month of September. So I want to talk about this move to the upside on each one of these. So the first point is that it's easier to track what influences individual stocks versus indices or currencies. So now if we take a step back from using technical analysis alone, most retail traders underestimate the power of understanding the role of catalysts of news when it comes to volatility. People trade many different ways, but if you can position yourself to trade what has the most directional skew and you apply setups to that, then it's more likely that you'll consistently be able to beat the market. So stocks have more focused catalysts versus Forex and futures. And I use Forex and futures in the broad sense. I know in futures you can trade currencies, but as most people understand it, when you say Forex, they think of currencies. When you say futures, they think of indices, commodities, etc. So with stocks, you have a focused catalyst, and with Forex and futures, you have a more broad catalyst. Focused catalyst can be company earnings, new products, new contracts, clinical trials, successful clinical trials, and more. The Forex and future space, macro catalysts normally drive these tickers. So you'd be looking at things like inflation, interest rates, monetary policy, and more. So if we go back to our example here, if you have some consistency with something like SPX 500, sometimes it's in a range like you see here, and sometimes you have really big moves. There are a lot of macro themes that are pushing the overall market. And when those macro themes are active, this is when you get the best moves. So you can derive consistent edge from the market when these things are in play. The challenge is that you'll have these periods where something like indices is ranging for 20 days at a time, and it can be harder to track when you'll get these larger moves. So many people come to me and complain that they had a strategy that was working, or they were consistently profitable for 2 months, and then they chopped up their account. Now, why do the broad catalyst move SPX 500 versus single catalyst like you see here? Summit Therapeutics was ranging, then you have news, and then you get a multi-day rally. The catalyst is focused, is specific to this particular company, and you can track this move and you can build edge around stocks that have news. You don't need to become a fundamental analyst. You just want to know that it has some sort of sufficient news. So with something like indices or commodities, it's harder to track influence since the calculation of the indices has so many stocks. It may make it harder to have consistent edge because there's arguably a higher degree of randomness with an index that has 500, 130 stocks that influence its price versus something like a single stock, which has a focus catalyst. So some of the top names from September: Laser Photonics, Summit, you had GLMD, GSIW, SMCI, you had PLCE, right? All of these you can see that there was directional skew here in September, and all of them are caused by a catalyst that you can track. you had the Chinese released several stimulus packages. So you're going to see a lot of the China names gave an easily trackable directional skew because of that. Here, these are all China names: JD, Baba, UXNI, Duo. These are all names that gave directional skew that can be easily tracked back to a clear catalyst. If you use the catalyst driven strategy, this will help you beat the market consistently year after year after year. Okay, point number 2. Forex and futures are generally more efficient than equities. That's a more academic word. Let me explain what this means and why it's important to you and I. So here we take SPX 500. This is the release of CPI. Then we have something like GLMD that had fresh news. So generally, when you have an event that causes a price to spike on indices or even currencies, normally there's an immediate reaction. And that time window that you have between the release of the new information and the price action is generally a small window. But at the release of new information in the equities market, oftentimes, especially for small caps and stocks that don't have a lot of attention, there's generally more time to take advantage of that new information. So if you saw the CPI release come out here and you tried to take advantage of that fresh news to that broke price out of that previous range, you actually won't be able to take advantage of that because the price action moves fairly quickly and corrects itself. GLMD, fresh news comes out, we have some movement in pre-market, and then once the market opens, you actually have a few hours where there's price discovery. And during that price discovery, this is where you can get scalps. Now, why is this the case? Okay, for stocks, for equities, you have less sophisticated professionals or investors oftentimes, where in the currency space or the future space, since they're so liquid, they're dominated by institutions and algos. And this is where most people come with the argument that if it's an algo, you can figure the algo out and it's calculated. But a lot of times the algos are calculating information in nanoseconds, and they are designed to beat humans. Okay, now another thing that's related to this point about efficiency is that with equities, since there are different types of traders involved in these moves, especially when there's a fresh news catalyst, then people digest information at different speeds. Again, going back to this price discovery that you can take advantage of. For example, in September, PLCE, it had earnings and then multi-day rally. So different types of investors or traders started piling into this, and it gave us the ability to have over a few days that earnings information led to price discovery, which gave us the ability to take advantage of buys for several days with this particular stock. Capricorn Therapeutics is another one. Late September, news catalyst that led to several days of a rally. And the most extreme cases of these are like your NVIDIA's and SMCI, which we will get into later on. So what does this mean for you and I so far? I haven't talked about leverage. I haven't talked about the market being open 24 hours. A lot of times that's what people lead with, especially the marketers. And that's because they aren't focused on edge. I'm focused on having consistent edge and beating the market. The first 2 points that I mentioned so far, number one, with equities, it's easier to track what influences because of focused catalysts versus broader markets like gold, platinum, copper, indices, which have macroeconomic influences. And it makes it harder to pinpoint day by day what is actually moving those markets. So a lot of times people are trying to interpret random price action. For example, this mess right here on gold that lasted for a month, and they are applying a bunch of SMC and other types of terms to what's happening here, when in general, if you just take a step back, a lot of this is random price fluctuations due to different market conditions, due to daily buying and selling, institutions adjusting their books, other investors buying and selling different assets. When we see directional skew. This is attached to some geopolitical event or macroeconomic catalyst, but those are harder to track. Just think back to January, February with Euro USD. I know a lot of people blew up accounts in January and February here in this choppy market. If you're enjoying this content, please send this to someone that needs it. This isn't your normal video talking about how futures offers more leverage or futures is open 24 hours. It doesn't matter that futures is open 24 hours. If you're in the Asian session trying to trade SPX 500 and nothing is happening, then you won't make money. You can't develop a system with consistent edge. Point number 3, wider range moves. So stocks, particularly small caps, they can move on average 20, 30, 50, 100, 300%. If you open up the scanner, there's almost always a few names that are above 50%. On average, indices will move about 1% plus or minus. On really good days, you may get like a 2 to 3% move max. So when you're looking for those 5R, 8R, even 10R trades, it's more likely that you'll get them over here on the stock side. Let's take a look, a few examples. We look at ATNF here, pre-market, we had a momentum play. And here, buying the stock here about $8, at about $8, have consolidation. This is a breakout momentum play. So even if you didn't catch the entire move of, this is a 1 to about 1 to 6 R trade, catch it even higher. This is almost a 1 to 10. So if you risk 1,000 here, you'd easily make 6K, maybe even 10K. Beginning of pre-market to the pre-market high is 900%. This is a trackable influence, as I mentioned, a focused catalyst. Wolf had a strong catalyst the day before and then had a strong move to the upside here, 41% pullback. And then today, strong push to the upside and then a break continuation move here. This is about a 1 to 6 here until it starts to move flat, right? Strong move here. So again, as I mentioned, 1 to 5. These are happening. Both of these happen today, right? So you have wider range moves on individual stocks from the open to the high of day. This is 22%. Point number 4, more opportunity. At first, I thought that if I was to focus on a small set of indices and commodities, maybe 4 tickers, that this will be better because I'd be able to specialize and master these. But what I found is that because of the tighter ranges, sometimes you have periods where indices are ranging for 2, 3 weeks, 4 weeks, where price action is choppy. But if I was to trade whatever is giving me my particular setups in the US stock market, there are over 5,000 stocks. Almost every day, there is something that is giving us an asymmetrical risk to reward, a skewed direction. So since there's more opportunity that gives me edge day by day, I don't have to sit there and try to trade a tight range. Rather, I can catch large momentum moves almost every day. Since there's more opportunity, this allows me to maximize my time and capital. Many people are sitting in front of the screen. They show up every day and then whatever they're trading is not ready. Maybe they show up 2 or 3 times out of the week and nothing. So this is being inefficient with your time. Also with your capital. If I have a stock account with 10K buying power and let's say a futures account with 10K buying power, this 10K is going to be turning over and making and generating more money because I have more opportunity day to day. I may take 2 or 3 or 4 trades or maybe even more because there's more opportunity. So for example, while SPY or SPX was in this range here with choppy price action, this is 20 days here. In September, there were several names that were booming. As I mentioned, SMMT, right? PLCE here, directional skew here. So all these China names were in play because of the China stimulus, okay? Multi-day rally. So I'm showing you these moves that gave us directional skew that we can tie back to a catalyst, either multi-day rally or a strong catalyst intraday that gave us a strong uptrend. All of these names that I'm showing you are names that appeared in September or early October. Look, DJT, because of the election, you got the Donald Trump media here, uptrend rally, right? Capricorn Therapeutics multi-day rally, right? So multiple stocks here that all gave very good long trades that we could take advantage of. Palantir Technologies, this is another one. Strong trend here, continued. Okay, now a lot of you may have been thinking this entire time, what about leverage? And pure leverage in the futures market, as well as leveraging eval accounts. I think the choice here is one that is counterintuitive. Like, this is not a direct analogy, but buying cheap products versus expensive quality products. So cheap products may save you money up front, but investing in high quality may be more expensive, but it lasts longer, works better, and ultimately will cost less over time in most cases. So the counterintuitive option here, right, is the maybe more expensive, higher quality. So intuitively, you may say, well, if I go with eval accounts versus a stock account, I can purchase 2,500 in buying power for $50, let's say. So this is very appealing. The fact that you can purchase $50 of 2,500 of buying power for $50. So a low initial cost, okay? Limited financial risk because this is a demo account and you're gonna get paid from the demo account, okay? So up front, it appeals to your rational senses to say, this makes sense. But I'll tell you, after speaking to hundreds of students and helping hundreds of students, people are blowing through these accounts. I mean, people have reported to me that they spent between 5 to 10K with either one payout or no payouts. So what I believe is happening here is, number one, of course, there's some skill development that needs to take place. So people may be gambling. But I do also think that since futures is more efficient than stocks, meaning that arguably harder to beat, there are some market conditions where futures, like indices, for example, gold, may be ranging for 2, 3 weeks, 4 weeks with choppy conditions. It makes it harder for a lot of these traders to remain consistent. There's a greater degree of randomness. And I'm not saying that none of the traders make, consistent money with futures. What I'm saying is that arguably stocks are less efficient and stocks will offer you more opportunity. You can have a less degree of randomness if you're trading stocks that are in play. So what happens is, first you say it's a low cost, but the cost of blowing these accounts and spending this 50 adds up before you know it. Take a moment and stop and think about how much you spent. Now, some people know how to play the game. Some people have played the game very well. They have a good challenge to payout ratio. But for the most part, I think that most people are really struggling here because you get $2,500 in drawdown, which is like $2,500 in buying power, pretty much in your max loss. You have 2,500 and then you have to make 100% to pass the challenge. Okay. So you have to, in the futures market, you have to make 100%. And then to get a payout, you have to make 100% again. Okay. You have a lot of people trying to use the aggressive payout method and they're blowing through this money. So originally it started off as low initial cost, low barrier to entry. And then these fees start racking up. In my opinion, after seeing and being I've traded Forex, I've traded futures, I've gotten payouts from both CFD and futures companies, okay? And traded stocks. What I would do if I was starting all the way over is I would be saving this money up and trading demo or very small size here. If you're worried about PDT, there's ways around that 25K. You can trade cash accounts, you can split your accounts. So I wouldn't let that be an issue because of all the things that I mentioned before. Opportunities of edge, trackable catalysts, all that stuff. You'd be able to grow an account over here, in my opinion. And again, this is just me offering a perspective to the space, okay? So I'd like to hear if you agree or disagree. So just think about the cycle that you may be in if you've been struggling. And I've seen it up close. I've seen students struggling and then have to reset. Maybe they get one payout. They hit up really bad market conditions. It's hard to track the catalyst and how we're going to move out of these ranges. And then maybe they go into deep drawdown on the funded account. Then they have to start all over pretty much. They have to grow an account 130% pretty much before they can get to the funded stage, right? Where growing an account 100%, is more likely easier here in the stock space, day trading, because of the amount of edge, because of the amount of range, because of the amount of opportunities. There's so many more reasons to start over here. I was just going to do a whole build out of like, let's say you start off with 2,500 here in the eval account, like, and you buy with 12 accounts, and then you start off with 2,500 here, right? And then show how at one point, you'll cross, even if you're getting payouts, some payouts here, you'll cross over with the stock account. It'll take some months, but you'll cross over and you'll be live with live money here. You'll own it 100%. You're not dependent on the eval account firm. And then you have a consistent rising equity curve and real edge rather than using the payout to challenge type of edge ratio. A lot of people are using that, but don't have real consistent edge that they can realize with a live account. This right here will lend to longer term success and longer term scalability. And you can build a business around this because you have control over your money. Okay. All right. So these are just thoughts for you to consider. I'm going to be making a lot more stock content, how to grow a small account. All that is coming. Please like and subscribe. Let's have a discussion in the comment section on this. Want me to do a part 2 on this video? Let me know. If you want to see a video on how I make 10K in a month if I had to start over, watch this video.